Have you ever found yourself daydreaming about a future where financial worries are a thing of the past? Imagine having the freedom to pursue your passions without the constant stress of making ends meet. This isn't just a pipe dream. By staying with us till the end, you'll unlock the secrets to building wealth through investments, a path that has transformed lives and can do the same for you. Let's dive into the world of investments with a countdown of the key strategies to build your wealth. Starting with number 9, we're exploring the foundational steps and moving through to the most crucial and often overlooked tips. 9. Diversification, the art of spreading risk. Ever heard the saying, don't put all your eggs in one basket? This is the essence of diversification. By spreading your investments across different asset classes, you minimize the risk of catastrophic losses. Think of it as a safety net that catches you if one of your investments falls. It's about creating a balanced portfolio where the success of one investment can offset the failures of another. Imagine you're at a buffet. Instead of filling your plate with just one dish, you sample a little bit of everything. This way, if one dish doesn't meet your expectations, it won't ruin your entire meal. Similarly, diversification in investing ensures that your financial health isn't dependent on the performance of a single investment. The practical step here is to start by assessing your risk tolerance and then allocate your assets across different categories like stocks, bonds, real estate, and even cryptocurrencies. Each of these has its own set of risks and rewards, and by mixing them in the right proportions, you can achieve a balanced portfolio that grows steadily over time. As we move on to our next point, consider how diversification might play a role in your investment strategy. Could it be the missing piece in your journey towards building lasting wealth? 8. Long-term planning, the visionary's approach. Building wealth is not a sprint, it's a marathon. The most successful investors are those who look beyond the immediate horizon and plan for the long term. This approach requires patience, discipline, and a clear vision of your financial goals. It's about seeing beyond the fluctuations of the market and focusing on the potential for growth over years or even decades. Imagine you're planting a garden. You wouldn't dig up the seeds every few days to see if they've sprouted. Instead, you water them, ensure they have enough sunlight, and give them time to grow. Investing works in a similar way. By committing to a long-term strategy, you give your investments the time they need to overcome short-term volatility and truly flourish. The key to long-term planning is to start with the end in mind. What are your financial goals? Retirement at 55, a college fund for your children. Once you have a clear target, work backward to create a roadmap. This might involve setting aside a fixed amount of money each month into a retirement account or investing in a 529 plan for education savings. 7. Financial literacy, empowering your investment decisions. Knowledge is power, especially in the world of investing. Financial literacy is the cornerstone of a successful investment strategy. It involves understanding the basics of the financial markets, the different types of investment vehicles available, and how to read financial statements. This knowledge empowers you to make informed decisions, identify opportunities, and navigate the complexities of the investment world with confidence. Think of it as learning to drive. Before you hit the road, you need to understand the rules, how the car operates, and how to react in different situations. Similarly, before you invest your hard-earned money, you should understand the financial instruments you're using, the risks involved, and how to manage those risks effectively. To enhance your financial literacy, start by dedicating time to educate yourself. Read books on personal finance, subscribe to investment newsletters, attend workshops, or even take online courses. The more you learn, the better equipped you'll be to make decisions that align with your financial goals. Now ask yourself, how much do you really know about your investments? Are you familiar with the terms and concepts? If not, it might be time to hit the books. Your future wealth depends not just on the money you invest, but also on the knowledge you bring to those investment decisions. 6. Risk management. Navigating the waters of uncertainty. Investing inherently involves risks, but understanding and managing these risks can significantly enhance your chances of success. Risk management is about identifying potential threats to your investment portfolio and taking steps to mitigate those threats. It's a proactive approach to protect your assets while striving for growth. This strategy is akin to sailing a ship through stormy seas. The goal isn't to avoid all storms, as that would be impossible, but to navigate through them with as little damage as possible. Effective risk management starts with diversification, as mentioned earlier, but it goes beyond just spreading your investments across different asset classes. It also involves setting stop-loss orders to limit potential losses, regularly reviewing and rebalancing your portfolio to maintain your desired asset allocation, and being aware of the tax implications of your investment decisions. Consider the concept of an emergency fund as a form of risk management. By setting aside a portion of your wealth in a readily accessible form, you ensure that you have financial support in case of unexpected personal crises without the need to liquidate your investments at a loss. The path to building wealth through investments is marked by careful planning, knowledge, and a keen understanding of risk. As we delve deeper into the keys to successful investing, remember that managing risk doesn't mean avoiding it entirely, but rather understanding and mitigating it to your advantage. 5. Regular investment and compound interest, the magic of growth. One of the most powerful concepts in building wealth is the practice of regular investment coupled with the magic of compound interest. This strategy is about consistently investing a portion of your income over time, allowing the returns to compound and grow exponentially. It's akin to planting a tree and watching it grow over the years, where the initial seedling gradually becomes a towering giant, providing shade and fruit. The essence of this approach lies in the discipline of making regular investments, regardless of the market's condition. This practice, often referred to as dollar-cost averaging, helps smooth out the volatility in the market and reduces the risk of investing a large amount at an inopportune time. Over time, the compound interest on these investments can result in substantial growth, turning modest regular contributions into a significant portfolio. To harness the power of compound interest, start by setting up automatic contributions to your investment accounts, such as a retirement fund or a diversified portfolio. Even small amounts, if invested regularly and allowed to compound, can lead to impressive sums over the decades. Now, think about your approach to saving and investing. Are you taking full advantage of the power of compound interest, or are you missing out on potential growth by not investing regularly? Remember, the earlier you start, the more you can benefit from the compounding effect, turning time into your greatest ally in the quest for wealth. 4. Understanding market cycles. Timing vs. Time in the market. Grasping the concept of market cycles is crucial for investors aiming to build wealth. Market cycles refer to the periodic fluctuations seen in the financial markets, encompassing periods of economic expansion and contraction, bull markets and bear markets. Understanding these cycles is akin to a surfer who studies the waves before paddling out. It's about knowing when to ride the wave and when to sit tight. The debate between timing the market and time in the market is a long-standing one. While timing the market attempting to predict market highs and lows to buy low and sell high can be tempting, it's incredibly difficult and often counterproductive for most investors. On the other hand, time in the market maintaining a long-term investment stance, regardless of short-term fluctuations, has historically proven to be a more reliable method for wealth accumulation. Consider this. It's not about the daily movements, but the overall upward trajectory over years and decades. By staying invested through the ups and downs, you allow your investments to grow through compounding returns, benefiting from the long-term growth trend of the markets. 3. Smart asset allocation. Crafting your financial blueprint. Smart asset allocation is about strategically dividing your investments among different asset categories, such as stocks, bonds, real estate, and cash. This isn't about randomly distributing your funds, but rather carefully crafting a financial blueprint that aligns with your risk tolerance, investment goals, and time horizon. It's akin to an architect designing a building, where every material and structure serves a specific purpose, contributing to the overall integrity and functionality of the building. The right asset allocation can significantly impact your investment portfolio's performance and volatility. For example, stocks offer higher growth potential, but come with increased volatility, making them suitable for long-term goals. Bonds, on the other hand, provide more stable returns and are considered safer, making them ideal for investors closer to retirement or with a lower risk tolerance. To create a smart asset allocation, start by assessing your financial situation and goals. Are you saving for retirement, a down payment on a house, or your child's education? Each goal may require a different allocation strategy. Then, periodically review and rebalance your portfolio to ensure it remains aligned with your objectives, especially as your financial situation and the market landscape change. Now think about your own investment portfolio. Does your current asset allocation reflect your risk tolerance and investment goals? Are you diversified across different asset classes to mitigate risk and maximize potential returns? Remember, a well-considered asset allocation strategy is your financial blueprint, guiding your investment decisions and helping you navigate the complexities of the market with confidence. 2. Proactive tax planning, keeping more of what you earn. Proactive tax planning is an often overlooked but crucial aspect of wealth building through investments. It involves strategies to minimize your tax liability and maximize your after-tax returns. Just as a gardener cultivates their garden to yield the best harvest, effective tax planning ensures that you keep more of your investment gains, allowing them to continue growing. Taxes can significantly impact your investment returns. Understanding the tax implications of different investment accounts, such as Roth IRAs, traditional IRAs, and 401ks, is essential. Each account type has unique tax advantages depending on whether taxes are paid at the time of contribution or withdrawal. Additionally, being aware of capital gains taxes and how to use tax loss harvesting can help reduce your tax bill and enhance your portfolio's overall performance. To engage in proactive tax planning, consider working with a financial advisor or tax professional who can help you navigate the complexities of the tax code and recommend strategies tailored to your individual circumstances. It's also important to stay informed about current tax laws and regulations, as these can change and affect your investment strategy. Consider your current approach to tax planning. Are you taking full advantage of tax-advantaged accounts and strategies? Remember, it's not just about how much you make in the market, it's about how much you keep after taxes. Effective tax planning is a critical component of maximizing your wealth-building potential. 1. Continuous learning and adaptation, the keystone of investment success. The final, and perhaps most critical, key to building wealth through investments is the commitment to continuous learning and adaptation. The investment landscape is ever-changing, influenced by global economic conditions, market trends, and technological advancements. Staying informed and being willing to adapt your investment strategy in response to these changes is like a navigator constantly adjusting their course based on the stars and the seas. It ensures that you remain on the path to your financial goals, even when the environment around you shifts. Continuous learning, like watching this video and subscribing to our channel, involves regularly educating yourself about financial markets, investment strategies, and economic indicators. It means staying curious, asking questions, and never becoming complacent with your current level of knowledge. This might involve reading financial news, following market analysts, attending seminars, or participating in online forums. The goal is to keep your investment knowledge current and your strategy aligned with the best practices for wealth building. Adaptation, on the other hand, is about being flexible with your investment decisions. It's recognizing when a particular strategy is no longer serving your goals and having the courage to make changes. This might mean reallocating your assets, exploring new investment opportunities, or revising your financial goals as your life circumstances evolve. Are you actively seeking out new knowledge and willing to adapt your strategies based on what you learn?